So thank you to everyone. Welcome to this webinar. For those of you who have joined, it's some odd times in other jurisdictions. This is a webinar where we are going to be discussing with panelists who have been involved in writing the paper Opportunities for Applying Actuarial Techniques in Banking. So I welcome you. Thank you very much. So the way we are going to do this is we have got our panelists and we have prepared a few questions that we are going to be going through to allow discussion. We will do that for about 45 minutes to 50 minutes. And then from there, as you post your questions and your comments, we will also go through those questions and comments that we hope will be, that will be either in the chat or in the question and answers section. Hopefully you put most of your questions in the question and answer section to make it easy for us. As a way of introduction, my name is Michael Tchareva. I am the chair of the IAA Banking Virtual Group. And just as a way of background, I qualified as an actuary in 2004. I'm a fellow of the Institute of Actuaries in the UK and a fellow of the Actuarial Society of South Africa. I qualified as a pensions actuary. That's the subject I wrote. And then I transitioned into banking in 2008. Ever since then, I've been practicing banking. I would like to give an opportunity to our panelists to also introduce themselves. I will start with Ian. Ian, your mic was on. You can mute it when you're speaking, but you can introduce yourself now, and then we can get others to introduce
Thanks,
themselves.
Mike. So I am Ian Allen. I'm Deputy Chair of the IA Banking Forum, working with Michael. I've worked in banking for more than 30 years, during which I've had 3 different careers. One, working for UBS in investment banking, sales and trading. Secondly, working for the Scottish Bank, Royal Bank of Scotland, as head of strategy across all its activities. And thirdly, in the last 10 years, as an independent consulting, helping small banks with applications for banking licenses. Thank you.
Thank you, Ian. Tafara, you can come next.
Thank you, Mike. So my name is Tafara Mwandi. Qualified as a life insurance actuary in 2012. I'm a fellow of the Actuarial Society of South Africa. I'm currently based in California, where I transitioned from, core actuarial to work in the field of cybersecurity, where I help, the largest banks in the world deal with the cybersecurity threats.
Thank you very much, Tafara. And Jennifer?
Thanks, Mike. My name is Jennifer Chansey. I became an associate in the Society of Actuaries in 2018, and I'm working towards my fellowship. I hope to be done next year in quantitative finance and investments. I work for a regional bank holding company in the Eastern US, and I work on bank stress testing and reserve modeling. Thank you.
Thank you very much, Jennifer. And then Rajiv.
Hi, thanks, Michael. Good day, everyone. I'm Rajiv Kumar Singh. I've been in the financial services banking environment, particularly credit risk, for the last 12 to 13 years. I've worked at 3 of the 4 major banks within the South African region. I've done credit risk modeling for the banking portfolios and trading book. But over the last 8 years or so, I've been at ABSA Bank in the corporate and investment banking division, implementing strategic and tactical technology solutions and processes across the African continent. I've also traveled extensively to the region. I've got interest in ESG, impact investing, venture capital, project private equity. Outside of that, I'm finance director of a non-profit organization. Like to give back to the community as well. I'm also observer member of the Banking Virtual Forum. And as part of the Actuarial Society of South Africa, I'm the deputy chair of the System and Technology Committee. Thank you.
Thank you, Rajiv. And then we also have Nancy Kelly, representing the IAA, who has helped us put this webinar together. So thanks to Nancy. Now, going into the issues we're going to discuss today, as a way of background, some of you would have seen the IFOA and the Actuarial Society of South Africa last week launching the revised banking subject that now has got two papers, which is the principles and the advanced. So you will, if you go through that, say after this webinar, if you have not yet done that, you will see that paper, this paper that we are discussing today, touches on a lot of those issues that are also contained in the new syllabus that is being launched with exams starting in 2022. So this is quite an exciting area of practice, which is quickly expanding and becoming more and more global based on the work that we have been doing over the past 4 years. Actually not 4 years, actually over the past 7 years. Oh, well, for me, over the past 12 years. So it's a long time we have been doing that. Now, I would like us to get into the paper. This is the first probably of a series of webinars. Today, we have a few questions that we have, but please join the next webinar. If we announce that we are going to have the next webinar in 2022, join, because the questions will be different. It won't be the same. This webinar is being recorded, and the next webinar won't be the same, but discussing exactly the same paper. All right, so, Ian, I would like to start with you. But before I go on, maybe let's look at the slides. Let's look at the slides quickly, 2 minutes. Let me just see here. My view is, okay, I can't really see the slides. I'm a bit, okay. If we look at the slides, let's see if I can see these. Okay, yeah, so this slide just lists the people who have been involved in putting this paper together, which is Ian Allen with us today, Jennifer with us today, Kudakwashi Mpandawan is not with us, then Tafara Mwandi is with us today, Rajiv Singh is with us today, and I'm also here. The paper was reviewed by the IAA Scientific Committee, as it was called then, and also members of the IAA Banking Forum, as it was called then. Then there are members of the Actuarial Society of South Africa who also reviewed the paper. If you look at the next slide, you will see that the paper is on the IAA website. If you haven't seen it, you can go there and you can download it and read it. If we then look at the next slide, these are the contents of this paper, which covers a section on what are the opportunities for actuaries in banking, then a paper on a case for the actuarial function, then issues of capital adequacy, then issues of credit risk and capital modeling in banks, covering all the different types of risks. Then you have got retail banking business models and retail banking pricing or pricing of products in retail banking from a fair pricing point of view. Then you have got pricing, the retail banking pricing and profit analysis, and then the move, just a summary of why there was a move from International Accounting Standard 39 to IFRS 9. And then you've got the current expected credit loss for US banks. So IFRS 9, International Financial Reporting Standard 9, is applied elsewhere in the world. In the US, this is applied in the form of a current expected credit loss. Then you've got some actuarial techniques being discussed in US banks that are applied in US banks. And then customer analytics in the world of big data is also there. Then operational risk, cloud, and cybersecurity is also a chapter in this paper. Systems and technology is also another chapter in the paper as applied to banking. And then, we also have an annex or appendix that we summarized some time ago, where Ian also gave a lot of input on evolution of the banking regulations, from Basel I to where we are now, where we have got Basel III. Some of them called it Basel IV. And that's the paper. But we are not going to, go into detail and discuss each and every one of these chapters. We just prepared our chapters in a way that reflects the importance of the chapter, how you can think about, up of the paper, and how you can think about this paper. Right, so Ian, now I come back to you. I don't think there is any other slide. I think the next slide will really be to do with questions, I would assume, right at the end. So I come back to you, Ian. I would like to start with you. You were involved in writing this paper and you did a great deal. And after writing a few chapters, you then helped in the final moments in going through the whole paper and making any changes that came through the peer review from our peer reviewers. Now, if you stand and look back today at the whole paper, what do you think of it?
Thanks, Mike. So first of all, I would like to put in record our thanks to the reviewers whose comments were very useful and helped to bring the paper together. When I was doing the review, I was very much on chapter by chapter, but hearing you going through it now, I'm pleased with the way it turned out, because you asked us to submit chapters on our areas of interest. But without going through every chapter, when you look at this table of contents, it covers a lot of the things in banking in which actuaries would be interested. So it does cover credit risk. Credit risk is the main risk in banking, credit risk on loans. Related to that, you make provisions for expected credit losses. This has been a hugely important issue over the last 18 months as forecasts for economic growth have changed because of COVID-19. Really important, really interesting. And then once you've made the forecasts, if you get a recession, your capital is reduced. And so the capital adequacy assessment is important, not just for credit risk, but for all risks in the bank. So these are mainstream banking things. At the same time, with COVID-19, we're very conscious that banking really is transforming itself, moving into the digital age. So although it's not my areas of expertise, I was very pleased that colleagues submitted comments on systems technology, customer analytics, big data, operation risk, fraud, cybersecurity, very important issues about which regulators are concerned as well as banks. And it's great to see that actuaries are involved in this IT transformation of banks. So all this and a lot more in 100 pages. So as Michael said, writing this paper for me was extremely useful. We started writing drafts a few years ago and worked on the reviews and the comments. But when the IFOA and ASA agreed to look at these new banking subjects, having already done a lot of work on this was very helpful. Final comment here, just to remind you, if you haven't read the paper, this is not about actuarial techniques. We assume you're familiar with the techniques. The point of the paper is to talk about opportunities where you use your existing techniques in banking. Thanks.
Thank you very much, Ian, for going through that. So Rajiv, if I come to you, you were also involved in the final review of the whole paper prior to final publication. What insights can you share?
Thanks, Michael. I agree with all of Ian's comments as well. I was initially involved from the beginning and right up until the final review and publication. by the time it came to me for the final review, I think most of the comments and changes were incorporated, and I had to just do the final touches, dotting the I's, crossing the T's. But I think it encompasses all the core aspects that the actual profession is involved in banking, and I think it gives a good summary of the opportunities for anybody looking to join banking from other actual areas. I think it's easier to use this as a base, and for people in the insurance industry to apply some of the principles in banking. I think it'll be easier to go that way than maybe from banking to insurance. I think it is a bit of a long read, but a very good one. I do think as well, people currently working in this areas could use it. But I actually refer back to it sometimes as well. And anybody not in the actual profession can also refer to this and pick up on some of the information that's provided. I've also shared this paper quite widely with my colleagues within ABSA Bank and on social media networks. And I've got good reviews that they have found that the paper has been well written, and it gives them a good an understanding of where actuaries and actual people are involved in banking. I think that as well, this could potentially be expanded and made into a book. But I think as well, there are probably aspects as well that we could add on, given that since the time of writing this paper, the world or the environment has changed. For example, climate risks, ESG, quite key. Blockchain and cryptocurrency probably could be added. Basel IV changes that's coming could be an addendum that we do on this, FRTB, and various other aspects in the regulatory framework that's coming. I think we're going to be busy for the next few years. And yeah, I'd just like to thank you again for the privilege to be involved in this paper from the start, and looking forward to building on this going forward.
All right, thank you very much, Rajiv. So there you got it. This is a paper that could help you understand the techniques that you already know and how to apply them in banking. So Rajiv and Ian have just given you the background and the confidence that you've got to read this paper. Only this week, someone came to my LinkedIn and said, I want to move to banking. What can I read? And I said, okay, well, you haven't been following. I simply said, come to my email, and I sent this paper to them. So very useful paper. Thank you very much for the summary. So Jennifer, if I come to you, having written the chapter on current expected credit losses, which is applicable in the US, it is very clear that you've got great knowledge in this area. How has your background in actuarial science helped you with your understanding of expected credit losses?
Yeah, that's a really good question. CECL is a highly complex, open-ended problem. With CECL's current expected credit loss, that's how we refer to it in the United States. And basically what regulators were saying was, we expect you to calculate a lifetime loss rate for a loan, but we're not going to tell you how to do it. So banks were left to decide how to forecast the probability of default of a loan on a forward-looking basis, and to determine how much they needed to set aside in reserves based on that probability. To me, that's no different than an insurance company reserving for a policy. Insurers know that there's a non-zero probability that a policy will have a claim, otherwise the policyholder wouldn't be buying insurance. So what's the probability of a claim, and how much will the insurer have to pay if there is one? That's very similar to trying to figure out the probability of a loan defaulting and how much a bank could lose if it does.
Thank you, Jennifer. So there you had it. That's CECL, current expected credit loss. applied in the US, very similar to IFRS 9, International Financial Reporting Standard number 9, which is expected credit loss. So expected credit loss is simply equal to probability of default multiplied by the loss, given that there is default, multiplying by the exposure at default. You can go into detail there, you can do your analysis, and you can see that it's very similar to the way we calculate some of the claims provisions in the insurance industry, especially general insurance. So Tafara, I would like to move to you now. And I would like to ask the question, you have written a chapter on cybersecurity, and you know what, this is quite a new area, quite interesting, probably very few actuaries. You're one of the few in the world, I would assume, in this space. You displayed great understanding of this area when you wrote that chapter. How can actuaries add value in cybersecurity? That's the first question. And linked to that, is it your opinion that this is an area more for computer science specialists? And if so, where do you see actuaries fitting in? So that's a question for you, Tafara. Thank you.
Thanks a lot, Mike. Cybersecurity is a very wide field. And as a result, there's some aspects of cybersecurity that do require someone with, very strong technical computer science type background. Many times when people think of cybersecurity, they, think of the, Hollywood images of computer hackers wearing hoodies and so forth. There is aspects of cybersecurity that deal with hacking, where you are looking at particular websites, applications, data systems, and trying to see if there's any vulnerabilities where people can break in and steal valuable items. That particular section of cybersecurity, I would say, requires someone with very strong technical and computer science experience. But there's other aspects of cybersecurity where someone with the skill set that an actuary would have, or anyone with actuarial training, could actually add a lot of value. And in the paper, I highlight some of those. Some of those would be, for example, if we talk about cyber insurance, companies need to buy policies to cover them in the event of a cyber threat or a cyber event happening. Those policies need to be designed, they need to be priced, and there needs to be evaluations that occur. So this is very similar to what you would do in sort of a traditional actuarial work, but now working towards cyber-related threats as opposed to life risks or risk to general property. There's also a lot of the work that I do, which is around fraud modeling, where you are designing computer models whose job it is to detect anytime when there's cyber fraud happening, similar to, for example, credit card transactions. How do you know which credit card transactions are legitimate, and how do you know which ones were actually being done by a fraudster? And developing models to detect those, to prevent those, and to reduce any losses. The skills that you get from an actuarial training are very well suited for this kind of work. There's also work that is done with regards to, for certain companies that either are unable or unwilling to purchase cyber insurance, they might want to hold some reserves on their books to be able to cover any losses that they might incur due to a cyber-related event, or due to fines that could be imposed. For example, in the EU, they've got GDPR, which imposes very steep fines on organizations that get hacked. And then there's also a lot of work that's done, for example, in the enterprise risk management space, similar to like the role of a chief risk officer, where as an actuary, you would be responsible for all the risks that a bank undertakes, including any of the cyber risks. So all of those are areas where I think actuaries can add value in cybersecurity.
Thank you very much, Tafara. So there you had it. Tafara is at least one of the few actuaries I know who has ventured into this space of cybersecurity. That's actually an area I actually think actuaries should play in. So I would like to go straight to Rajiv on this, because Rajiv also wrote a chapter on systems and technology, and this cybersecurity issue is really to do with systems and technology. So if I come to you, Rajiv, I'm going to ask you a question. Systems and technology is actually an emerging area, and I know you've been working in this space since I've known you actually at Absa Bank, which is one of the big 4 banks in South Africa. What are some of the skills needed and actuarial techniques that can be applied within the systems and technology area. In 2 minutes, what can you tell us in this question that I've asked you? Thank you.
Yeah, thanks, Michael. Yeah, so it is an emerging area. So only about 3% of ASA members are involved in this area, and it's been flat since we started tracking that metric. But we've seen an increasing number of actuarial skills moving into the space. So if I just have a look at some of the skills that can be applied, or techniques, so for example, on assessing new technologies or systems that need to be implemented, you can apply some of the business case skills, for example, what's the NPV, IRR of actually implementing or putting that investment into those new systems. It can also be use the skills around making the system or the environment or the technology environment a bit better by applying the actual control cycle of defining what the problem is, coming up with a solution and monitoring the effects. The actual profession has a lot of risk-adjusted mindsets where taking into account the enterprise risk frameworks and ensuring that the operational uncertainty environments of the whole bank is satisfactory. And also around thinking strategically, on looking for and being forward-looking and making financial sense of the future, we can use our skills to forecast of where banks need to position themselves to be relevant in 10 to 15 years' time. If you have a look at some of the actual codes and practices, they're quite generic and they align to any space, and system and technology is not different to having those codes applied to it. But the skill set needs to be augmented with complexities of software development lifecycle, change management lifecycle, project management lifecycle, and various new coding languages and techniques around project methodologies. But actual skills being in the space is not to replace the existing computer science people or developers. It's to augment and make the bank better.
All right, thank you very much, Rajiv. So Tafara and Rajiv, you have covered this area, cybersecurity. Rajiv, you have spoken about systems and technology, quite interesting areas in this digital era that we are in, with digital transformation taking shape in almost every organization and especially banks. Now, I'd like to go to some of the core issues, and I'm going to go back to Ian. So you, Ian, wrote one of the chapters on capital adequacy assessment in banking. And I believe from my understanding of your background that you have actually worked in this area. Can you tell us about the work you have done and about this chapter? We have got about 20 minutes to be dealing with all these questions that we have. So yeah, so I'd like to ask you, Ian, to come in on this question I've just asked.
Thanks, Mike. As I said, I've worked in the last 10 years as a consultant, helping a number of new entrant banks with their applications. In the UK, lots of new entrant banks. And one of the central challenges for them is the capital adequacy assessment on their business plan and forecast. The bank's got to satisfy itself and its regulator that it has enough capital for its business plan and there is a capital buffer to allow for all the scenarios where things could go wrong. The pressure is on the bank to do it and the regulator to approve it. For me or anyone who's an actuary, this is actually a great way to learn about banking because it covers all activities and all risks. The process is set out in the chapter, no need to repeat it, but to summarize some main points, there are 3 stages. First of all, minimum capital requirements, basically following the Basel regulations or other regulations. Not simple, but following the rules, either standardized approach or internal model approved by a regulator. Secondly, of more interest to actuaries, you have to hold additional capital for risks not already properly covered. Here, like Jennifer said, the regulator don't specify. They say you should understand your risk, you decide how to quantify them, and we'll look at it and approve it or amend it. Thirdly, very familiar to many actuaries, stress testing to quantify the buffer, allowing for adverse scenarios, serious economic problems, or cybersecurity, or the two together, and allowing for management actions. Two final points. If you worked in an insurance company on an ORSA, it would help, but it's not at all necessary. And finally, this is a particular area which may be attractive to consultants, as I've been recently, because if you do this for one bank after another, you get to see different issues and can really add value and help banks. That's the capital adequacy assessment, the ICAP. Thanks, Mike.
No, thank you very much, Ian, but you see, you haven't finished. This is very related to another chapter you wrote. So I'm going to come back to you again with another question before I move to the next panelists. So you wrote this other chapter on the actuarial function, you know. So, you know, when you talk of capital adequacy assessment, there's ICAP, internal capital adequacy assessment in banking. And if you liken it to insurance, that's where we have got Solvency II, commonly known as Solvency II, named other names in other jurisdictions. But then you came and wrote another chapter on actuarial function. What was the main point of you including this chapter? So this is a related question.
The main point was to prepare actuaries for the surprise that there is no formal equivalent of the actuarial function in banks. That may look odd. We can see a lot of merit in an actuarial function, and insurance actuaries are familiar with it. But of course, in banking, people like Jennifer do similar things in different ways. In the banking I'm familiar with, we think of three lines of defense. The first line being the business unit, the second being the control function, like risk or financial strategy, and the third line being internal audit. And many actuaries would not work in the actuarial function, but they would work in a second line of defense function, doing the ICAP or risk model governance, or expected credit losses, or things like that. So it's different, but it turns out on the day job to be pretty similar. So the familiarity you have with review and challenge is pretty similar in banking within a different structure.
Thank you very much. You know, you remind me about 2 or 3 years ago, I presented at the Actuarial Society of South Africa convention, and I included this chapter on the actuarial function as the last topic in my discussion. And I had, you know, I asked people to vote who were in the audience. It was quite a reasonably sizable audience. And I said, would you recommend an actuarial function in banks? And you know what? 92% said yes, they can recommend the actuarial function in banks. So thank you very much for bringing this aspect. You can go and read the chapter and you will see how similar what's happening in banks is the same thing that's happening in insurance entity. In fact, Ian, you brought the issue of 3 lines of defense. I was marking a paper on life assurance, by the way, just before the ended exams of the Institute of Faculty of Actuaries. And one of the past papers, it was like I was marking assignments for someone to help them. One of the questions asked, what do you understand about the 3 lines of defense? So that was a life assurance paper. So I just started laughing because, you know, I smiled and then I started laughing because it is exactly the same thing. So there you have it, banking and insurance almost the same. Now, I would like to move to Jennifer. You know, Jennifer, you know, there are 2 questions I'm going to ask you. The first one is that, and I'm going to ask them together. The first one is that, what opportunities do you see for actuaries in current expected credit loss going forward in the US? That's the first question. The second question is, because Ian spoke about stress testing, so I'm going to ask it at the same time. That's another important area where you showed a lot of knowledge when you put up a chapter on stress testing in US banks. What types of stress tests do banks currently use? So you've got two questions there. Opportunities you see for actuaries in current expected credit loss, which is IFRS 9 elsewhere. And the second question is the types of stress tests that are done in banks today. So that's for you, Jennifer. Thank you.
Thank you. So in terms of opportunities and current expected credit losses, overall, I see just improvement of the current processes in banking. Models can always be improved. Any actuary with reserving experience could provide a fresh perspective to the industry, I think. Also, the largest banks in the United States implemented current expected credit loss standard at the beginning of the COVID-19 pandemic, which was quite literally the worst time to implement any standard, but this standard in particular. And of course, after any significant event, there are lessons to be learned. A lot of econometric models were broken by the pandemic. And so actuaries can help banks figure out why certain models failed and help develop more robust alternatives. Turning the stress test. Oh, go ahead.
Yeah, thank you for that. Yeah, you can go to the stress testing one question.
Yes, in terms of stress testing, there are three main stress tests that I've been involved with in banking. Those were capital, liquidity, and interest rate risk. I think all of these stress tests really emphasize the most important risks to the banking sector. Regulators want financial institutions to be well capitalized because this promotes the stability of the institutions. Banks need adequate liquidity to support loan fundings, but they also must be able to meet consumer withdrawals from, say, checking or savings accounts. Additionally, banks need to be aware of the interest rate risk they're exposed to. Right now, rates are extremely low, at least in the United States. And the Federal Reserve has indicated that it will raise rates at some point in the next year or so when it believes the economy can handle it. So it's very important that a bank knows how its balance sheet will respond to these interest rate changes. I think of all of these things as being interrelated, but they're critical to test separately so that the bank knows where its weaknesses are. Thank you.
Thank you very much, Jennifer. No, thank you very much. That's an illustration of how actuaries are applying their skills within the banking space, which means there are lots of opportunities, lots of areas that have not yet been explored. Now, Tafara, I'm going to come to you and I'm going to ask you two questions. And the first question is that, what are some of the similarities between the cybersecurity work that you do for banks and the more traditional actuarial work? So that's the first question. The second question is, do you believe that actuarial education, the current actuarial curriculum, is well placed to enable the transition into cybersecurity? So those are two questions. So the first question is similarities between cybersecurity work and more traditional actuarial work. The second question being, do you believe the actuarial education curriculum is well placed to enable the transition into cybersecurity? Those are your two questions, Tafara. Thank you.
Sure. Thanks, Mike. I think there's a lot of similarities between traditional actuarial work and sort of the work that I do in the cybersecurity space. I think for starters, I think the actuarial control cycle is extremely versatile and can be applied to many different sectors, including a lot of the work that we do in cybersecurity in terms of the iterative sort of development approach, continuously improving the things that you're doing. But to illustrate, I guess, an example of some of the similarities, I'll take, for example, something that is well understood within the banking space, which is credit risk modeling. Where you are trying to identify the probability that a particular borrower will default on a loan. If we take this into the cybersecurity space, You are trying to identify the risk associated with a particular digital transaction. That transaction might be a login into a bank account. You're trying to say, what is the probability that this person logging into the account is the owner of the account versus is not the owner of the account. Looking at things like credit card transactions, what is the probability that this particular transaction is authorized and done by the owner of the card, and what probability is there that this transaction is actually unauthorized and it's someone who has stolen someone else's card. So we look at pretty much very similar models in terms of, what is the probability associated with that particular event. And there's models that are based off past data, where you take past fraud data, where you have had reports of fraud, and then you say what were some of the things that were similar about these transactions that were fraudulent versus not, and then you build models that are able to predict whether a particular transaction is likely fraudulent or likely not. You also have models about the expected loss, right, depending on the size of the financial transactions that are going on, and then you can be able to estimate, what is the loss given, the loss given fraud, I guess, which is the equivalent of, loss given default. So all of those are like some of the analogies that I would, like to highlight, that, a lot of the models that are used in traditional banking space can also be applied into the cybersecurity space. And similar to, credit modeling, where you're trying to have the outcome being, do I issue this individual a loan at standard rates? Do I give them, a higher interest rate, or do I deny them the loan altogether? In the cybersecurity space, the outcome of all the modeling we're doing is also trying to determine, do I allow this transaction to happen? Do I escalate this transaction to maybe, step up authentication? Maybe you need to do a one-time password or some other, form of escalation, or do I decline this transaction altogether? So all of those are, just high level, giving you some of the similarities that exist between sort of some of the traditional actuarial work that happens within the banking space versus some of the work that I do in cybersecurity. And then the second question, I guess, was with regards to education. I guess a disclaimer is that, since I qualified in 2012, I haven't been very, involved in sort of the education side of things. But from the little that I've seen and heard, I think a lot of strides have been made, I think, in updating a lot of the academic material. I think a lot of work has been done by, a lot of people on this call to ensure that, the banking subject comes up, and that a lot of content with regards to systems has been put in. But I think there's still a lot of work that has to be done to actually build out sort of, if cybersecurity and systems are going to be a full practice area, some work needs to be done. But as I have highlighted, a lot of the models that already exist and a lot of the approaches that already exist are already relevant to some areas of cybersecurity. But to further increase, the areas in cybersecurity where actuaries can have an impact, I think there needs to be some improvement and some key skills. For example, introducing training on programming, computer and networking and cybersecurity basics, etc., which, to the best of my knowledge, are not currently a requirement for you to become an actuary.
No, thank you very much. That's very critical. I mean, you can see even the banking itself started off it's called wider fields, right? Which is where you are right now. And when educational material was prepared, we're seeing a lot of people writing the exams. The IFOA and ASA have now launched the new syllabus, the new banking subject, just to add to the board of knowledge and to have more people doing it. So I agree with you. I think it can start as just being included in within the courses, so that people can be aware of this. So this is great. Thank you for giving that insight. So I would like to move to Rajiv. Now, given the digital transformation, I've spoken about it earlier, and I'm a fan of digital transformation, by the way. So given the digital transformation initiative by banks across the globe, what are some of the areas within the bank that people can get involved in, and the career path progressions? So this is one question, but related to the pace at which technology is changing and increasing faster than before. The next question is, what are some of the mega trends that banks need to be aware of and need to capitalize on now in order to be ahead of the curve? So you have got two questions there. right? Some of the areas within the bank that people can get involved in, and the career progression paths under digital transformation. And then the mega trends that the banks need to be aware of and need to capitalize on now in order to be ahead of the curve. Those are your two questions, Rajiv. I hand over to you. Thank you.
Thanks. Yeah, so I think Jafar has mentioned a key space is around cyber security and cyber risk, and that area, but also as well with digital transformation, which is around using digital technology to create and modify existing processes, culture, customer experience, and meeting the business changing needs and market requirements. So it involves technology, data, processes, organizational change. And some of the roles that are involved in this is generally within the strategic execution office, where there will be business analysts type of roles, business managers, project managers, change managers, doing a lot of the analysis work in implementing these technology solutions. Then there's system product owners and managers to help shape the actual value that the technology and the system produces for both the bank and also for the end users and clients. From there, it could be that you move into the head of change role or head of digital transformation, head of strategic projects. It could also further on the career progression could be that you move into a chief operating type of role or chief data officer. I think that's where, given that we work with a lot of data and big data sets and using Hadoop, and the head of data or chief data officer is probably going to be a key one. Also, given that we augment the skill set with some of the technology aspects on infrastructure, networking, maybe the chief information officer or technology officer. But whatever role is that people might want to go into, it's to leverage the techniques and what we've learned and use that to create value, new systems, enhancing existing systems and processes in order for the banks to remain agile, relevant into the future. And that leads on to the next answer to the next question is some of the mega trends that's in place besides cyber security and cyber risk. It's AI, ethical AI, machine learning, big data, and tech. So banks have spent, I think, close to $40 billion in 2020 just on IT infrastructure alone, and just the whole IT costs generally for the globe has been, I think, close to $3 trillion, which is a massive amount. And those are some of the projections for 2021. A lot of them is related to some of the human capital costs that are to those roles that I've mentioned, but also it's related to some of the infrastructure costs. And we need to have the infrastructure in order to build the technology solutions, in order to use them. Some of the other trends is around blockchain and cryptocurrency. I don't think it's going to be, banks cannot ignore it anymore. The market cap, I think this week reached $3 trillion. And I think where we can see some of actual skills being used there is around risk management, building techniques and solutions around that. New products where on the back, like we've seen EFTs being approved very recently in the US. Non-NDFs have been started being trading. There's savings in cryptocurrency. We can help shape the regulations. The regulators shape it to build moats for the bank, or actually have enabling regulations for the space. Also, as well, is around how do our AML systems or KYC systems align to the space. There's cloud technology, which is also a trend, quantum computing, Internet of Things, virtual reality. There's so many things happening in the system and technology space, and it's always changing. I think banks need to look to see where the trends are, and where it can position itself to take or benefit from these trends, and position itself and build the capabilities now, because we tend to, according to Amara's law, tend to overestimate the effects of technology or the impact of it in the short term, but underestimate it in the long term. So we don't want to underestimate it in the long term when the banks are not resilient and the market share is taken up by the fintechs that come in. Also, we need to take care or look at some of the changing customer base, Gen Z, Gen A's, which are already digitally native, and how do we cater for this market, and then how do we enhance our systems and technology solutions for this market. But at the same time, we also need to comply with regulations and not incur too much of technical debt, and making sure that our systems don't become too inefficient with implementing too many solutions. And also, we want to ensure that there's not lack of straight-through processing or integration, or a lack of automation. Some of these trends. Yeah, thanks.
So you can go.
Yeah.
All right. Okay. All right. Yeah, you can finish off. That's okay.
Yeah, there's robotics, process automation as well, and I think a lot of the banks are looking to experiment in the space. Some have existing programs or invested quite heavily yet, are starting to use AI, RPA, and some of the other technologies that I've mentioned. Banks might not be affected directly by all the changes in technology, but it might be indirectly affected. And I think we need to see how those effects or that impacts banking as a whole.
Okay.
Yeah.
All right. No, thank you very much, Rajiv. So there you had it. You know, I will bring one statement that I've always heard over and over again over many years by Frank Reddington. Some say he said in 1956. I'm not sure if that's the correct year, but he said a statement that will live with us for centuries. An actuary who is just an actuary is not an actuary. So I'll repeat this. An actuary who is just an actuary is not an actuary. What does that mean, at least in the context of what we are discussing here? You're going to have to constantly reinvent yourself, learn new things, don't just remain in that actuarial space, which means these issues we are discussing today, systems and technology, cybersecurity, and the issue of applying all the actuarial techniques that we have been learning for so many years, take them and apply them into banking, or apply them in other areas, not even banking only, but other areas. So don't rote learn the syllabus, and then you go out there and say, I'm an actuary, and then just start doing the same thing. You're going to have to innovate. So thank you very much for all this input. I do appreciate. So now I've got one question each for you that I'm going to reserve probably until the end, but let's see, because we've got maybe to go to some questions if we have questions now. And right now I see in the question and answer bank, there might be just one question. So I'm going to come to you panelists, depending on how the question has been asked. So there's a question from Catherine Lee. Catherine says, why restrict who sees questions? Oh, okay, I'm going to read it anyway. Why restrict who sees questions? If we were together in a room, we would actually give our name and question for everyone to hear. Because there's a question, I don't know if there's any restriction. Nancy, is there any restriction there? Because there's a question there. That maybe there's a restriction question. I don't think they are restricted. I think everyone is seeing the questions being asked, because on my side, that's the only question I've seen. So there is no one asking questions, it seems. So I'm going to go to maybe in the chat box, maybe there are questions that have been asked, but I'm going to go through and check if there is any question. If I look here, there does not appear to be any question. I can see people here, you know, just commenting, like Catherine Lee is commenting. Sarah Jane has commented as well. Moses Nkwanta from I think Malawi has commented. Who else? Okay, I can't see. Yeah, does not seem to be any question. Some Catherine here has got a comment, says HR can be very interesting in analyzing turnover, sick patterns, peak vacation leave, or human capital planning. That's just a question. There's a question. There's a point. Panelists, give us some hints about why you think the opportunities give us growth in the banking sector and somewhere to be excited about. Then that is from Catherine Lin. She goes on to say, hoping the panelists tease us with what's in the paper to drive us there. And then she also says, interesting to hear how central bank experience is different from other banks for actuaries. So that's those are comments from Catherine Lee. Catherine, I will start by answering you, and I'm going to get views from the panelists on the issues you have raised. Firstly, in terms of how they give opportunities for growth, this area is already big. In some countries, practicing in banking is now even bigger, or getting bigger and approaching and probably passing practicing in pensions. So all you need to do is sit down. There's a lot of literature out there. Read the paper itself. I think, you know, in 1.5 hours, we're probably not going to be able to do any justice. Read the paper itself, speak to actuaries working in bank. There are a number of them. Go on the IAA website. There is a lot of material. The recently launched subject in banking, go and look at it. You will find yourself excited just on your own, just by doing all of that. So, and in the paper itself, I think the best way to be teased is go and read it, you know, go and read it. Select chapters. The chapters are not linked, so you can actually read each chapter on its own independently. So I think that's something you can do, Lynn. I don't know if there are any views from panelists, obviously without taking a lot of time. I can ask if there is anyone who wants to make any other comments based on what Lynn has been saying. Maybe, you know, I don't know. Yeah, Ian, you can go. Yep.
Having been in it 30 years, what excites me today and would make me happy to do another 30 years or another 60 years or 90 years, there's always new problems to solve. Tafara and Rajiv have talked about some of the new IT problems. I was involved in different aspects of banking, but there was always something new. As Jennifer knows, the recent COVID-19 stress in banking is quite different from the banking crisis 15 years ago. Banking is really the economy. It has its ups and downs. There is always something new, but looking at the future, we can see banking as big in data. The Governor of the Bank of England pointed out that banking is second only to retail in the amount of data, and technology is making that accessible. When I was young in a bank, it was in the mainframe, you couldn't see it. Now you can get it and use it. So banking is moving online, it has data, it's central to the economy, it's very exciting.
All right, no, thank you, Ian. If there's anyone else among us, the panelists to add some comments, I see Tafara, you wanna add something there?
Yeah, I think I was just going to add in terms of what Catherine Lynn mentioned in terms of applications of actuarial techniques to HR. There's a very smart analyst that I employed a couple of years back who was coming out of the big HR companies, where he was doing a lot of interesting data analytics and data modeling with HR data. I think there's a lot of things there where actuaries could add value. There's things around, I think you mentioned, you know, sick patterns. If you think about the largest employers in the world, people like Amazon, it would be very valuable for them to know how to estimate how many workers they need on a particular shift expect, given how many people they expect to not show up on a given day because they're ill or they had other responsibilities. And there's ways that some of the models that we have already developed can be useful in that space. If you think about airlines also have the problem of overselling tickets because they know that some percentages of people won't show up for a particular flight, and how all those things actually are modeled out with the probability and sort of the trying to maximize how many tickets exactly do you sell, which flights are going to be problematic versus not, and identifying those ahead of time. So I think there's a lot of areas, I think not just HR, where our actuarial techniques could actually be applied. And I don't think there's anyone looking at those areas at the moment.
All right. No, thank you very much, Tafara. I don't know if any Jennifer or Rajiv, you want to add anything so that we move to the next issue. All right. Okay. No, thank you. So the last comment here that I see from Pedro is that enterprise security and fraud management is a growing space. It's interesting to hear it being discussed in the actuarial space. Definitely, yeah, and I think Tafara has given a comment there saying this space is growing and actuaries have skills that can add a lot of value in this space. Yeah, so that was a comment from Tafara. So I would like to go back to the panelists again, because there is no other question that I can see either in the chat box or in the question box. So I will now go back to the panelists and ask you the questions that I reserved for you. So I did say I'm going to reserve some questions. So I'm going to go to those now. Let's see how I can bring this up and ask. So I'm going to start with you, Ian. So there are two questions for you, Ian, but I'll just ask you the first one, where you wrote some chapters on retail banking. Why did you focus on retail banking rather than corporate banking or investment banking? That's a question for you, Ian. Thank you.
Yeah, I'd be happy to go back and work in investment banking. I could brush over my derivatives hedging. It's good fun. It's well paid. I can work in corporate banking. If I did, I'd probably focus on leasing and the quantification of residual values. The reason I wrote the chapters on retail banking is because there is real opportunity for actuaries there now. I didn't admit that I started training as an actuary in 1969. I couldn't have thought of working in a retail bank then. It would be pretty dull. Retail banking is really transforming, but it was the Cinderella area, the unloved area of banking compared to corporate and investment banking. Retail banking always had tons of data. From banks' relationship with customers and current accounts and credit cards, we know as much about you as you do, all within data protection rules. Now with open APIs, customers can authorize that data to be transferred to other providers, forming huge databases, so that people like Tafara and Rajiv can get the machine learning people to get value from the data. Now, for actually looking at retail banking, one option is to work for a fintech, which may be a bank or a non-bank, which is very smart in extracting value from the data. And it needs to have a range of people. It needs to have machine learning people. It needs to be people who know about products and regulation all working together. But this is disruptive innovation that the large banks are aware of. The large banks are not asleep at the wheel saying, let these fintechs take our lunch. So I see large banks making huge transformations to respond to the threat of the fintechs. So in retail banking, whether you work for the biggest bank in the world or the smallest bank in the world, this is a really exciting area of transformation at present. Lots of opportunities.
No, thank you very much. And when you say that, for sure, in terms of data, in terms of things, fast changing business models, that is happening in retail banking. For example, data analytics, artificial intelligence, machine learning tools are being applied in retail banking to analyze customer data so that you can understand the behaviors of customers, how they do their buying, how they use their accounts, what they like, just through data analytics. And with that, you're then able to design products that are more appropriate for the customer. So you're quite right. So you're quite right. Digital banking has loads and loads of data that a clever bank, if they use that data carefully and cleverly, they will really own the client, because they will be able to design what's appropriate. So thank you very much for answering that. I'm going to move on to Jennifer. Jennifer, you spoke about stress testing earlier. What opportunities do you see for actuaries to improve stress testing in banking? That's your question, Jennifer. Thank you.
Okay. I would say that in general, stress testing methodologies are relatively simplistic. Obviously, I think the JP Morgans of the world are probably using sophisticated modeling techniques. And simplistic models are not always a bad thing, because a simple model is typically preferred to a complex model. But I'm talking about like the average commercial bank who maybe isn't using stochastic modeling or is not centralizing assumptions, scenarios, data, or processes. Ultimately, if this could happen with the help of actuaries, it could result in more effective and cohesive decision-making. Another thing that I really see picking up in the US, and I've actually been pulled into recently in my own bank, is climate stress testing and scenario analysis. I think it's a great opportunity for actuaries to get in on the ground floor of the next big project in banking.
No, thank you very much. You bring climate change analysis as part of the banking virtual group. I actually posted something there to do with climate change, just to allow some debate. And I know that Ian, if we leave this webinar without Ian commenting on climate change, he may be unhappy. I'm not sure. So Ian, I know you might have views on this. Maybe can you come in? It's not only in banks, by the way. Climate change is affecting almost every company in the financial services and beyond, including insurance companies and other companies. But Ian, I know you have had comments before on this item. You like it. So I'll allow you to make some more comments based on what Jennifer
Thanks, Mike. This is obviously an improvement in this paper. If we redo the paper, there's an area where so much has happened and we need to update it. For me in banking, if I were a young actuary, this is the area I would go for. Banks are being asked by regulators to do stress tests up to 2050 with COP. I'm in Edinburgh, near Glasgow, following it very closely, talking about up to 2050. For a typical bank, doing a 30-year stress test is just a new idea. Banks very much focus on the short term, maybe 3 to 5 years. And suddenly they've got to do these long-term stress tests. For an actuary, with the training we have, whether we're specialists in life and pension or not, this is quite familiar ground to us to think in those frameworks. Banks are looking for talent. They're not looking for actuaries or against actuaries. They're looking for people who work in multidisciplinary teams on this challenging thing. Stress testing is the focus of this year that regulators are asking, but it will obviously lead to the quantification of capital for climate risks and price over climate risks. And we go on to pricing in the discussion in Glasgow this week. Banks are centre of the economy. If banks adjust the pricing to price for climate change risk, that will itself have a reinforcing move towards market discipline and lower carbon usage and so on. So I've been very pleased in the last few months to meet a number of young actuaries who had gone into banking, and even if they didn't quite know what they were going to do, they've ended up in this climate change stress test team. It's very interesting, very exciting for their career. It gives them a huge career opportunity, because this is going to be the hot topic of the next 10 years. If you're in this team, you're obviously going to have contact with the finance director, chief executive, the board. People are going to be really interested in the subject. So you can go into a very well-defined and manageable area and become an expert in it and get a very sound basis for a good career in banking. So I do encourage young actuaries, climate change stress testing. The general approach in banking is no different from insurance companies. So insurance actuaries are familiar with climate risk, property casualty actuaries, general insurance we call them, can add particular value, but this is a really interesting area at present.
No, thank you very much, Ian, on that. And climate change currently is at the top of a lot of global leaders' minds, in companies, even in governments. So thank you very much. That's an opportunity. And this is also taking place within the banking space. Tafara, I'm going to move to you. Your question is, what advice can you give to individuals to keep themselves safe online? So we are here. Some of us don't know about this issue of cybersecurity. So what advice can you give us, Tafara? Thank you.
Thanks, Mike. I think there's a number of things I think that you can do to keep yourself safe. There's a number of things that large corporates and companies can do to try and secure their customers, but sometimes a lot of the errors lie on the end of the consumer, which is us. Sometimes due to our own ignorance, we do things that expose us or put us in harm's way. Some of the things that I would give that are just very simple would be the first one, which is a pet peeve of mine, is, do not reuse passwords. I think, most people use the same password everywhere. I think that's just, really bad hygiene. Also use strong passwords. A survey that came out last year says, password 123 is still the most popular password in the world. Like that just boggles my mind. Like, who's still using password 123 as a password? So, use very strong passwords and use, don't reuse the same password, because everyone is going to be hacked at some point. So at least if your password is hacked at one company, but that password doesn't work anywhere else, then at least it's only, you're limiting your exposure to just that one entity that was hacked. But if you use the same password anywhere else, and LinkedIn or pick a company gets hacked, then that username and passwords affects everything in your life, and it'll actually be really bad for you. Second thing is also just limiting exposure to like your credit cards. I think credit card numbers, card not present fraud is, I think, the number one sort of risk when it comes to credit cards. So if you have the option to use other forms of payment, like using whether it's PayPal or Apple Pay or Google Pay or any of these that don't actually expose your actual bank numbers or your credit card numbers, I'd always opt for those. Good email hygiene, I think, is another one. I think, don't open random emails, don't click on random links in emails. I think, it's also important just to be vigilant. I think one thing that I always tell people is, you're not that lucky. Like, you are the 1 millionth customer. Congratulations. You didn't. You're just not that lucky. Like anything that you see that seems too good to be true, I think, most likely, is, always be suspicious of inbound requests. I think yesterday I got a text message saying that my internet provider had a special offer to reduce my monthly bill by 50%, and I had to like call some number. I'm like, there's no company in the world that is calling you to tell you that you can reduce your bill. That's not happening, right? You need to just use just common sense that some of these things just, aren't real. And then, also just making sure that, if you have, any software that you use, just making sure that it's always up to date. Typically just set it to auto update, and that ensures that, it automatically updates whenever, new security updates and things like that can be are available. Yeah, and I think, just always making sure that, you validate the websites that you use, and that, you have a good antivirus installed on your computer. I think, if you do that, I think you're doing your part. And, if the companies, mess up on their end, then, at least it's their responsibility to make things right.
No, thank you very much, Farah, for those tips. And I can tell you now, a lot of mistakes happen. I'll tell you, I think it was 3 years or 4 years ago, I went to Cape Town, and then I had my iPhone. Now I'm out, standing outside, trying to call Uber in Cape Town outside. And, the guys there with the other taxis out don't like that. And someone just came running and snatched my phone, and they went away with my phone. So I reported the matter to the police. And after that, nothing was going to happen because it was a stranger. Then I came back home and I had my iPad and everything. I went in there, find my phone, and I put that and, until I managed to find someone who had my phone. And stupid of me, I was now using my iPad and my other iPhone. And within a few days, they sent a link. I thought, and I clicked that link, and you know what? Everything was wiped out, and that was it. And they unlocked my phone. So this happened to me. So I'm just saying this. It does happen. All right. So let's move on. Thank you very much for those tips. Let's go to Rajiv. Rajiv, there could be a lot more work that needs to be done in defining the actuarial control within the actuarial role within systems and technology. In your opinion, what are some of the what are some of the issues or work that has been conducted since our paper that we are discussing today has been written? And what do you plan or what do you intend to be doing in the coming years? That's a question for you, Rajiv. Thank you very much.
Thanks, Michael. Before I get into the details, there's a nice quote that I came across by Dr. Mark Farrell, fellow of the Institute of Actuaries. He says that the future may not be certain for new graduating actuaries, but if we embrace change, remain flexible, and upskill as necessary, then I believe the future is very bright. And I think some of the discussions that we've had here today does make the future very bright for our profession. And particularly on the system and technology side of things, being the deputy chair of the ASA System and Technology Committee, we have published, I think, about 5 information notes already across the different practice areas, pensions, life, and it's done some presentations to the banking environment as well on where the actuarial role and where we could play in that space. And some of the notes are quite generic as well and can be applied to banking. For example, systems testing and the actuarial role there, and how actuaries should be involved in testing and sign off, right from doing the business requirement documentation right up until changes are in production. We've also done a lot of work around the cyber space, doing cyber surveys just to assess the awareness within the profession. And we've published information note fairly recently. And we leveraged off a lot of the work that Tafara has done in this paper, and particularly tied it to GDPR and POPIA, which is the SA equivalent to that. Going forward, we're looking to do more information notes and actually share the knowledge as well with the different professional bodies. And we will feed into the banking virtual forum the work that we do, and we can leverage off that. Some of them will be around assessing new systems, how we replace legacy systems, data migrations, how we do that, and amongst other specific areas as well, practice areas. Longer term, 3 to 5 years, if there's enough material, we, in the short term, maybe incorporate some of this material into the existing actuarial subjects. Longer term, 3 to 5 years, maybe have, if there's enough content, which I think there will be, have maybe a core subject by itself. And ESSA has already started that conversations of how we can pull in system and technology into the existing syllabus. But we'll be happy to share the progress that we make there with the IAA and any of the other member associations.
All right. No, sorry. Okay.
Yeah.
Sorry about that.
Busy. Sorry, Michael. Yeah, it's going to be quite busy for us the next couple of months and years.
Okay. No, thank you very much, Rajiv. So this is great. As we go towards closure, because now we're going towards closing this webinar. This is great insight that we have had from our panelists who were involved in putting together the paper on opportunities for applying actuarial techniques in banking. So go and read this paper if you haven't read it before. And I think you will find a lot of things that are included in the paper that you are familiar with. And then maybe you can start making a transition if you're transitioning. If you're already in banking, you might start looking at new areas within the bank where you can apply your skills. So it is a good paper from my point of view, with wide-ranging issues being covered. Hopefully, we will update this paper over time. Hopefully, like Rajiv said, maybe it will turn into a book, who knows? We will be talking about these things as we proceed. So we now want to close, and I would like to go around to each and every one of you with some, the panelists with any closing remarks. We don't have any question here that we have got, but I'll start with you, Ian, on the issue of Basel. You know, you included the evolution of Basel, you know, in the notes. So combine that with any closing remarks. I would like a comment on from you on that. Thank you.
Yes, when I read a book, I may be quite lazy, but when it comes to the appendix, I just skip it because I assume it'll be boring. Now, this appendix may be boring, but it's quite useful. If you're going to work in a bank, you have to be familiar with the Basel regulations. They are minimum, they're not adequate for all you're doing, but you need to know them. And the problem is that there is no single document called the Basel regulations. They've evolved over time. There are lots of new papers. Some new rules replace old rules. Some new rules add to old rules. So the purpose of this paper was to do two things. One is to point you to the papers that you might need to look at to do your job in banking. We're currently in Basel III, partly implemented. As Rajiv said, the final part of Basel III coming in 2023. So it's already split into two parts and the market risk is separate. So it sets out the different papers you need to look at to be familiar with it. But I wrote it explaining the evolution because of two reasons. When you read the rules, sometimes you wonder, why is it done this way? But when you understand the evolution, you can see how and why they got there. And if you're in a bank working with experienced bankers who've been through all of that, it's very useful to know how it was, how it's been, and how it is now. So it may be the most boring part of the paper, but I hope you find it useful. Otherwise, this has been a very pleasant experience for me, because until this evening, or until we had a call prior to starting, I had not met the other authors. So it's been very, very nice for me to meet the fellow authors and learn more about their experience. The final point, Mike, is I'm afraid we're going to have to update it. So more work to do. Thanks, Mike.
Thank you very much, Ian, and thanks for the great work that you did in us coming up with this paper. So thank you very much. You have always been very resourceful. And let's continue with the work on the IAA Banking Virtual Forum with you as the Deputy Chair. Thank you very much. Tafara, I'll come to you with any closing remarks.
Yeah, thanks, Mike. I think it was a pleasure for me, I think, to work with, an amazing group of people. I think I was added to this group at the 11th hour as one of the last people sort of to come on board and to add sort of my 2 cents worth to this project. But interested to see, I guess, that there's interest in some of the work that I'm doing in cybersecurity, and sort of interested in working together to see how we can continue to grow this area together.
Thank you very much, Tafara, and excellent work you did on that chapter. When I read it, I had to read it about 2-3 times for me to actually understand. And then I realized, okay, you were making sense, but initially I thought, okay, what is happening here? So this is exactly what we need. Let's add to the board of knowledge by bringing all the knowledge that we have got and share through exactly what we have done here. So thank you, Tafara. Excellent. Jennifer, any closing remarks from you?
Yeah, and we've discussed it, other panelists have discussed it throughout their comments today, but the opportunities for actuaries are always changing. I was originally hired to do stress testing, and then I got pulled into current expected credit loss modeling, and now I'm getting pulled into climate risk modeling. So, there's always going to be more opportunities, and I think that's great for the profession and great for the paper that we're going to have to keep updating. But yeah, so if you're ever interested in getting into banking, you will probably have a new project every couple of years because there's such a need for actuarial techniques in the industry.
Thank you very much, Jennifer. And your contribution to the paper was great as well. We managed to get perspectives from the US side of things. So thank you very much for the contributions you brought here. And I think really you've had a lot of interesting history in your career, moving in all these areas, stress testing, then expected credit laws, now climate change modeling. That's all exciting within the banking space. So thank you very much. It's great to have you as part of our panelists and for your contribution to the paper. Now, Rajiv, closing remarks from you. Thank you.
Thanks. Yeah, it's been a very good experience. I really enjoyed working with this panel and learned a lot as well. And looking forward to working with everybody in taking this forward and building on this. Thanks.
Thank you very much, Rajiv. So on behalf of all the panelists, I would like to thank everyone for attending. And Nancy, thank you very much for working very hard to put this together. It's odd times, so we're going to do this webinar again with different questions, different perspective, maybe getting more technical. We haven't decided what we're going to do, but we will use the same paper to discuss all these issues about opportunities for actuaries in banking. So Nancy, thank you very much. Please stay with us in terms of continuing to arrange these webinars for us as we go forward. And otherwise, have a great evening to everyone. And those where it's morning, have a great morning. If it's afternoon, wherever you are, have a great afternoon. Thank you very much to everyone. Bye-bye.